What if you've just started in crypto, but you're not really sure on the difference between trading and investing? My name's Jamie Guy, you're watching What If Crypto, and today we're going to take a look at the basics of crypto trading and some of the basic terminology you might come across, just so you have a little bit of a better understanding what might be right for you, investing or trading.
Nothing in this video is financial advice, and everything in this video is for entertainment purposes.
Investing is when you buy an asset and you're just waiting for the price of that asset to increase over time. Maybe you're going to hold on to that for a year, 2 years, or maybe just a few months. You're just going to capitalize from the difference between the price that you buy the asset at and the price when you sell the asset at a later date. But ultimately, as long as the price is rising over time, you're going to be making a profit. Now, trading is a little bit different. Even though you're still buying an asset, you're not going to be holding on to that for the long term. You're trying to capitalize on any price fluctuation. So this is when the price is going up and the price is going down. If the price, for example, is starting at one position and then is finishing at a higher price, before it goes down, you would be trying to close out on that position. Now, this change in price is what's known as volatility. And you'll see it often in the chart, where the charts are going up and down like this. One of the key differences between trading and investing is when you're trading, you have the ability to open positions in both directions. As well as buying the asset and capitalizing profit when the price is rising, you can actually sell an asset and capitalize on the difference between the price when the price is going down. This means you have more opportunities to be able to take profit, but also it can lead to losses. When trading, you'll hear the expression opening a position. Opening a position is essentially just putting in a buy or a sell, so determining which direction you think the asset's going to go and opening a trade in that direction. You're trying to capitalize on short-term price changes. Now, many trading platforms allow you to take a short-term loan against the asset that you have, essentially increasing your exposure. What this basically means is that you're increasing your gains or your losses. For example, if I have an asset that's worth $100 and I have $10, I take $90 worth of leverage. I can buy the entire asset for $100, but I've only put in $10. Now, what this means is, where if I was only buying $10 worth of the asset, I'd only be able to take 10% of any change that I see in the graph. So for example, if the asset goes up by $1, I would only take 10 cents. If I have opened a position with 10x leverage, aka I borrowed $90 and I put in $10, when that price goes up by $1, I would take the entire dollar as profit. This increases the amount of profit that you can take, but be warned, it also means that if you were to lose $1 against your position, your loss would be magnified as well. If the asset was to decrease by $10 and I put in $10, the people who have lent me the $90 will want to reclaim that. This is what's known as liquidation. This is why when trading, it's very important to put in what's known as a stop loss and a take profit. The take profit would be the target price you're trying to reach and the point when you want to exit the trade. So for example, if you're putting in a buy, aka you're essentially saying that the asset's going to go up, you would set your take profit at the point when you think the price is going to start going down again to minimize your losses. Also, you'd want to put in a stop loss. So if you've opened a buy position, essentially saying the price is going to go up, but the price does the opposite and it starts to go down, you put in a stop loss to say how much of the overall asset that you've put in you're willing to lose. So again, let's say I put in $10, I set my stop loss at $2. It means that overall, if the price was to go down by $2, my position would close, and this would mean that I would still have $8 left, and I wouldn't lose my entire position. Trading, and especially leverage trading, is not for everyone. Your emotions can get in the way when you're trying to do a trade, especially when you see an asset rising in price, and you start to enter because you think it's going to continue rising in price, otherwise known as FOMO, fear of missing out. Very often, these can lead to losing trades. At the same time, when trading, you're going to have losing trades. Nobody has a 100% win rate that I know of. And because of this, you have to be a sort of person who can just take that on the chin and move on to the next trade. It's always important to do your research, always very, very important to make sure that you're checking the asset you're trying to buy to have an idea of where you think the price is going to go. Trading takes practice. So don't be disheartened if you're losing a lot at the start. If you're interested in trading, but you think that it might not be for you because it's too risky, and you want to know how you can trade without investing any money, check back next week. Make sure you hit the like and subscribe button, as I will be releasing a video telling you how you can do just that.